Welcome to Volume Mastery, the key to unlocking true price understanding. In this session, we dive deep into how volume reveals market intent. Volume is more than just bars at the bottom, it's the fuel behind every move. Once you learn to read volume correctly, price action becomes crystal clear. Let's upgrade your market vision with true volume insight. Volume tells you how many trades occurred within a single candle or bar. It reflects the strength, interest, and participation of buyers and sellers at any given time. High volume usually means strong conviction and active engagement from big players. Low volume signals hesitation, confusion, or manipulation. It lacks real support. But remember, volume only becomes powerful when you read it in the right context. Think of volume as the market's lie detector. It exposes whether a move is real or fake. When price breaks a level but volume is weak, it's likely a trap or manipulation. But a breakout backed by strong volume tells you that real money is behind the move. Always ask, does the volume confirm what price is showing me right now? When price and volume move in harmony, that's when your edge is strongest. Accumulation happens when smart money quietly builds positions in a tight range. Volume here is intentionally low. They don't want to alert the crowd. Occasional volume spikes may appear as liquidity is tested within the range. A real breakout from accumulation is usually obvious. It's backed by a volume surge. Patience is key in this phase. Let volume guide your timing, not impatience. The markup phase is when price trends upward in clean, impulsive waves. You'll often notice that volume rises during these strong upward pushes. Pullbacks during this phase should have lighter volume, showing lack of selling pressure. This imbalance confirms that buyers are still in control of the trend. As long as volume supports the move, staying with the trend gives you the edge. Distribution occurs when smart money begins unloading their positions quietly at the top. You'll often see volume start to fade as momentum weakens and buying interest slows down. Price tends to move sideways with occasional failed breakouts that trap unsuspecting traders. Sudden volume spikes during this phase may signal trap candles where smart money acts. Pay attention to volume divergence here, it's a warning that the trend may be ending. Markdown is the phase where panic selling takes over and prices fall sharply. Volume usually surges as traders rush to exit their positions, often in emotional waves. Bearish moves are typically backed by high volume, while pullbacks show reduced participation. Large volume spikes during markdown can signal capitulation, the final blowout of sellers. Let volume help you spot exit points or ideal moments to enter short positions safely. Before a major breakout, volume often contracts and drops to lower levels. This represents the calm before the storm, where liquidity quietly accumulates. Smart money waits patiently during this pause, preparing to strike with force. When volume surges again, it confirms the breakout is genuine and ready to move. Learning to anticipate this volume pattern helps you catch big moves early. Not all breakouts are what they seem. Many are fakeouts designed to trap traders. Fakeouts usually occur on low or declining volume, lacking the support of real participants. Price may briefly move beyond key levels just enough to trigger stop-loss orders. Then, it quickly reverses, leaving retail traders stuck on the wrong side of the trade. Always check volume carefully before reacting to breakout candles to avoid traps. Liquidity sweeps happen when price aggressively tests previous highs or lows to trigger stops. These sweeps often come with sharp volume spikes, showing strong participation from smart money. After the sweep, price may either reverse or continue the trend depending on context. Watching how volume behaves after a liquidity sweep can provide clues for your next move. High volume combined with a reversal pattern often signals a powerful entry opportunity. Volume divergence happens when price moves in one direction but volume moves differently. For example, price might make new highs while volume gradually decreases. This suggests that the underlying buying or selling strength is weakening. Divergence is often a warning sign that the current trend is losing momentum. Use it as a cue to tighten stops, reduce risk, or prepare for a potential reversal. In a healthy trend, pullbacks or corrections tend to occur on lower volume than the main move. This means fewer traders are willing to fight against the dominant trend direction. If pullback volume starts increasing, it could be a sign the trend is weakening. Always compare the volume on impulsive moves versus corrective moves carefully. Let volume be your guide in confirming whether the trend remains strong or is fading. Sudden and large volume spikes often signal key reversal points in the market. These spikes represent moments where buyers or sellers have become exhausted. Look for strong wicks on candles combined with these volume surges at support or resistance. These climactic points can indicate the start of a new trend or the end of an old one. When volume aligns with price structure, these setups become powerful trading signals. Low volume periods show a lack of conviction or commitment from market participants. Moves that happen on very low volume are often weak or false and should be treated cautiously. Avoid entering trades during these uncertain or indecisive phases. Wait patiently for the market to show clear signs of interest and volume support. Remember, no volume means no real intention to move, no volume means no trade. Key support and resistance zones tend to attract significant volume as traders react. When price approaches these levels, watch closely for how volume responds. Strong volume confirms genuine interest and increases the chance of a reversal. If volume is weak, the price may simply continue through the level without hesitation. Use volume as a filter to decide whether to trust or avoid trades near key zones. Big candles paired with high volume demonstrate real strength behind the move. Conversely, large candles with low volume often signal false moves or manipulation. Always compare the size of the candle with the volume bar beneath it for clues. The true story of price action lies in the relationship between candle size and volume. This helps you avoid falling for deceptive price action and fake breakouts. Climactic volume occurs during emotional extremes in the market, often signaling a turning point. These are moments when buyers or sellers have pushed prices to the limit. A candle with a long wick and a massive volume spike is often the climax of a move. However, waiting for price confirmation after such climaxes is essential before trading. These climactic events can present some of the best opportunities when timed correctly. Every candle on your chart has a volume story behind it, showing hidden energy. Don't just focus on price alone. Volume tells you about urgency and intent. Volume reveals pressure points where buyers or sellers are gaining strength. Think like a detective and uncover the narrative that volume creates. The market always leaves clues. Your job is to learn how to read them. Now let's recap what you've learned about mastering volume. Volume reveals intent, confirms price moves, and helps decode market psychology. You've seen how it behaves across phases, from quiet accumulation to aggressive markdown. It's not about one volume bar, it's about context, structure, and timing together. Use volume as your filter, your confirmation, and your early warning system in every trade. Congratulations, you've leveled up. You now see volume as market intent, not just bars on a chart. Use this edge to trade with clarity and confidence. Volume isn't noise, it's your signal. Stay sharp, stay in flow, and trust what volume tells you next. Next up, we're diving into the world of indicators like never before. You'll discover how to actually use tools like MACD, RSI, moving averages, and many more, the right way. We'll break down lagging versus leading indicators, hybrid tools, and the truth about what works, and what doesn't. You'll also see how to combine them with price action for smart, high-probability setups. Don't miss the next video, it turns technical tools into real trading power.